All right, so we're mid-September, not the year that you expected, but now you have to get ready for what's coming up next this fall. I'm not going to tell you that it's going to be a market crash. I'm not going to tell you that we're over with this and now we're going to go back up. What I'm going to tell you is we still have chain supply disruption. We still have inflation. We still have higher interest rates. The market is worried, and maybe you should too. However, there are a few things you can do with your portfolio to get ready and make sure that you can go through the next recession without any problems. My name is Mike Yehu, and I'm the founder of Dividend Stocks Rock. I'm also a passionate investor with this YouTube channel to help you invest with more conviction so you can enjoy your retirement. Today, I'm going to share with you 3 things I do every single quarter to make sure that my portfolio is ready for the next storm. So we're going to head onto my DSR Pro Report, a tool that I've developed at Dividend Stocks Rock to help thousands of investors managing their portfolio and sleep well at night. Let's do this. All right, so now we are inside my DSR Pro report. This is a report done quarterly after each earnings season. So you guessed it, the next one is coming up in the following days. The quarterly report, the purpose is to give you an overview of your portfolio and then enable you to do a deep dive in every single companies, telling you which went wrong and which went right for their earnings. So the first thing I do every quarter is I want to have a global review. So the global review starts obviously with the portfolio summary. The first thing I'm going to look at is my numbers. So 22 stocks, which is in line with what I want in my portfolio. I don't want to have anything over 40. Across all my portfolios, I have a little bit more than 20. Obviously, I'm like low 30s, but that's going to give you an idea. I am well inside my target. The average yield of 2.43, not incredibly high, but I still focus more on dividend growth than on yield, so that makes sense for me. The current dividend annual payment, almost $5,000, and as you can see, my focus on dividend growth. We do have almost 10% of dividend growth rate average over the past 5 years across my portfolio. So this means that my dividend payment will increase by 10% every single year if all those companies continue to do exactly the same thing that they did in the past. On the right, I have like the overall ratings. We're going to see that later on, but most of them are either exceptional buy or buy. So that's good. After looking at the summary, I feel great, but that's not enough information for me to know which step I should go forward. One thing here is they highlight that I have too much concentration in information technology and probably not enough into materials, energy, healthcare, and industrial. So now let's go to second level of analysis for my global review is the sector allocation and asset allocation. Obviously, sector allocation, they already told me in that report I'm overweight in information technology. Is it a good thing? Is it a bad thing? Well, here's the thing. If you are more than 20% concentrated in a sector, you will have higher fluctuation depending on what's happening in this industry. It's not necessarily a bad thing, but just to be aware that if tech stocks are having a hard time, well, hello 2022, right? Then my portfolio is gonna have like a hard time too. So I just have to be conscious of that level of risk. For the rest of the sectors, not too bad. I have a lot of them. They're well diversified. So maybe one thing I could do that quarter to make sure that I'm prepared for what's coming up next is to start selling a little bit more of my information technology sector. I've done that in the past, but they're still very strong and they're a little bit too much in that portfolio. Asset allocation, I'm always 100% equity, so I have like small dollars there that are just dividend payments. I reallocate them constantly, so I will never have close to 1% of cash. I always want to be 100% invested. The last step is to look at my ratings and to have a good idea of what's going on inside my portfolio. As you can see, most of my stocks are either buy or strong buys, which is a good thing. However, I do have a few companies I have to take care of in my portfolio in terms of dividend growth. So I have CAE and Disney that are dividend trash because They suspended their dividend during the pandemic and they never resumed their distribution. I decided to keep them for a while. The biggest reason is I believe in their growth potential. This obviously hurt my dividend yield for my portfolio, but in terms of returns, they're still in the positive, so I'm not losing money right now, and I'm going to follow them every quarter. So that completes step one, which is the global review. You look at your numbers to make sure that you're on set with your plan and what you want. So if I'm looking for dividend growth, I have almost 10% annual dividend growth, which is good. I have a lower yield, which makes sense, and 22 stocks. So everything works according to my plan. The second level is to look at your allocation. So I know a little bit higher into information technology. So if we continue to have a bear market in this sector, my portfolio will suffer more than a regular investor. And the third level is to look at my ratings. So far so good. I don't have any big red flags besides the overweight in technology sector. So the second step now of this review is to go a little bit deeper and look at my current holdings. So we're just going to scroll down here and look at my portfolio holdings. The first thing I'm going to look at is the weight of my portfolio. So in an ideal world, I would like to have equally weighted position. However, that's the theory, and in reality what happened is that some stocks are just doing a lot better than others, and then for some reason you might want to have a stronger exposure to a few companies that are doing so well that you want to benefit from those tailwinds. When you look at my top five, you see Alimentation Couche-Tard, Microsoft, Apple, Visa, and Activision Blizzard. So all great companies. Obviously, Activision Blizzard in this one has been added to that portfolio before Microsoft announced the acquisition. So hopefully it's going to bump up a little bit more, but I know that this one is just temporarily. As soon as the transaction closes, hopefully it's going to happen at the beginning of 2023, I should be receiving $95 a share, which will create a great profit, especially on a bad year. And then I'm just going to reallocate this money. When you look at the ratings of my top holdings, they're all very strong. So we're talking about 4s and 5. I don't have to be worried too much. However, you can see that on my top 5, I have 3 companies in the information technology sector. Microsoft and Apple are keepers, that's for sure. I might have to sell a little bit of Microsoft just to rebalance my portfolio. And then I have Visa. And Visa is a special company because it's like 1/3 of consumer cyclical, because if people don't spend, you're not going to make money with Visa. 1/3 of technology because they're a payment processor. And then 1/3 of finance because it's all about money transfer. So it's not exactly a tech stock, but it is classified like this. So I just have to keep that in mind. But if I take this one off my portfolio and I assume that it's like a little bit more like consumer staples or finance, then I would go down very close to my 20% target for each sector, which could be very interesting. So after the global review and after the weighting and ratings of each stocks, I'm ready to the third step, which is doing a deep dive on each of them. Now, obviously, you don't have to go through the entire investment thesis and flip through like 3 annual statements of each company every quarter. That would take too much time. You already did your due diligence in the past. You have those companies in your portfolio for a good reason. And now it's just the time to do a quick review on each of them to make sure that they're still following the path you expected. So here's the last section of the DSR Pro report, and this is where the magic happened with all the analysts tracking down all earnings information. You can see the first one are my top holdings, so Alimentation Couche-Tard and Microsoft. You have like 2 for each page. I already have like all the comments about the CEO, what he says, and then what we think of the quarter. You have the resume here, so I can see that Microsoft double-digit earnings per share growth, double-digit revenue growth. So everything looks very strong, very, very nice, but year to date at minus 20%, and that is obviously my Q2 report. So if you wonder how come it is so low, because I know that it has come back, but that's just show you how like fast a stock could go up or go down. So I might be a little bit concerned about losing 20% on one position, right? So one thing that I'm going to do, if this comment is not enough for me and I want to learn a little bit more, I could go on the press release right away, or I can go on Dividend Stocks Rocks to review the company in full. So I have the stock card that has been last reviewed on June 24th. I'm going to go through the entire stock cards to see what's happening, why the stock is going down. So I can see here I have like all the latest information for the quarter, and then I have the investment thesis to know like why someone would like to buy Microsoft. I already made a video on that, so you can go into the link description. And after that, I'm going to look at the dividend triangle. As you can see, this one is nearly perfect. So you can clearly see that the revenue trend is going up almost every single quarter, which is quite impressive. Same thing with earnings going up. Now we are almost to a plateau, so we'll have to check that. And then for the dividend growth, very steady, a perfect staircase. So this is the type of company that you want in your portfolio. So after looking at that, I'm like, you know what? It's just normal that sometimes the stock price went so high, it went down a little bit. That's just healthy for any stocks to have a pullback. Now it's slightly going back up, but in the end, my investment thesis will stand. The numbers are still there to back it up. So I don't really care about what's happening on a quarter-to-quarter basis in terms of price fluctuation. I only care if the company is still doing what it does best, and clearly it is working. At this point, if I'm still not sure, I can still continue to do the analysis, look at more graph, look at the potential risk, and look even at the debt to say, well, what's going on with the debt on there, right? And finally, look at the dividend growth perspective. So it's going to give you a lot of information to make sure that you're right on that stock. The point here is really just to do that kind of deep dive analysis on the stock that you're worried about. So technically, I should have not even looked at Microsoft, because in my report, it was rated as a 5 and the numbers are good. I don't even have to look at Microsoft. I might want to look at other stocks. So I'm going to pull out and then look at all the other stocks and make sure that the ratings and the information for the quarter makes sense. And if not, I'm going to do that deep dive and look at the complete company's profile and then make a decision. Most of the time, I'm not going to make a decision on a bad quarter. I'm going to take a note. I'm going to think about it. And then if the next quarter, things are not getting any better, and now we're still going sideways, and the company is not able to put everything back on track, then I will make a decision. So here's a quick summary to wrap it up. First thing is you do a global review to make sure that you're on track. Second part is you look at your holding distribution, look at the weight, look at your ratings to make sure that you have healthy stocks, and then just do a deep dive on the company that requires your attention. So bad ratings, maybe overweight, or a stock that has a massive price movement. For all the others, you let them in your portfolio. They should do well, and you have been able to review that every single quarter. So you don't have to go in panic mode anytime when you see the portfolio going down. Most of the time, this happens only because the market is down, and you know what? When the market crashes, there's no place to hide, but you know that you have solid dividend payers in your portfolio. You know they're going to continue to increase their dividend, and then you can sleep well at night. You don't have to worry about next earnings. I hope that you have enjoyed this video. Let me know about your process every quarter. I'm curious to know in the comment section. Tell me, what are you doing with your portfolio? How do you manage it from quarter to quarter, and how to make sure it is recession proof? Don't forget next week's video. We're going to talk about investing with confidence and never having to doubt yourself again. So make sure that you like this video or register to the channel to not miss next Thursday's video. And until the next time, don't forget to stay invested.